You're listening to the Practical Wealth Show with Curtis May.
Hey guys, welcome to another episode of the Practical Wealth Show. So you're in for a real treat today. I have a friend of mine and a great advisor, infinite banking practitioner from sometime St. Louis, sometime Arizona. He just told me. And Mr. Bruce Wehner. Bruce is a cash flow strategist, and he's the driving force behind the day-to-day business operations of E3 Wealth. And so Bruce brings the wisdom of small business ownership with the added talent of being an experienced educator. He was a teacher, football coach. Every time I see you, Bruce, I want to say, what should I do, coach?
Yep. Well, that's what a lot of people do that to me.
Yeah. So I was like, coach, that's how I feel about it. Every time I'm like, all right, what tell you one linchpin is Curtis. I'm waiting for you to tell me to do something. So so Bruce owned and operated an automotive business for years. Since then, he has met with thousands of clients to help them develop financial strategies that strive to provide cash flow they need to be successful while also building their long-term assets. He is the co-founder of the Money Advantage podcast, great podcast I listen to. And the podcast is to help entrepreneurs live the life they've dreamed of. And we're going to talk about, matter of fact, I'm going to start with this. One of his quotes is, "I'm always working and I'm never working. I love what I do. I'm able to educate my clients on approaches they haven't considered in the past that may ultimately help them build their wealth both today and in the future."
Yeah.
Bruce, welcome to the show.
Hey, Curtis. Thanks it's good to see you again. It's a pleasure to do this for you. I try to do whatever I can for the community. I think you and I both agree we have a lot of the same mindsets, but the community is a growing community of advisors and producers, insurance producers out there that are really trying to help each other, because we know that typical financial education has really failed a lot of people. And I know we're going to get into this a lot, but you asked me that quote, "I'm always working and I'm never working." And I think a lot of people out there say, "Well, wait a minute, I got to step away from my business, or I got to step away from my job. It's driving me crazy." And I say to them, then you're in the wrong job, or you started the wrong business.
Exactly.
So you need to make changes. Now, if you're not willing to make changes, well, then you can't complain. And I don't want to be harsh about that, but that's my old coaching philosophy.
Yep.
When I coach, I can't. Well, okay, you got to either practice it so you can, or we got to get somebody else to do it.
Right.
Okay, because I don't want to hear any excuses, because the excuses aren't going to get you anywhere in life. So I really don't separate my business from my personal time. And people are surprised at that. Like, well, why can't? Well, then you can never relax. Well, no, because when I'm talking to clients, I actually have a relationship to like they're my personal friends.
Yeah.
And you and I were talking about this before the podcast. It's like, hey, we don't want to do business with everybody. We just want to do business with people that believe what we believe.
Yes.
And what do we believe? And people say that to me. Well, what do you believe? Well, first of all, I believe in individual rights and liberties. And I believe that individuals can figure things out better than central governments can figure things out. And it just happens to be I think individuals can figure things out better than corporations can figure them out. And I think individuals can figure it out better than companies can figure out. Even our mutual life insurance companies that we love, you and I love,
right?
They still have their limitations because they have these talking heads at the top, and they're always putting limitations on creativity.
Right.
We can't do this. We can give you something, but we can't make an exception for that. Now that's actually good, right? Because insurance companies are a rock, and they can give us tools that we can actually be creative with. And I think that's what I try to do with each and every one of my business owners by using what I've learned over my life. And I think this will be helpful for you, Curtis. And you and I have had several conversations before, personal conversations, but I grew up I think we're almost about the same age. I was born in 1963. My mother and father actually took out a Western and Southern whole life insurance contract on me when I was born.
Wow.
Didn't even know it. Grew up through the 60s. My dad owned a Shell service station. I saw a business owner from a very young But then when I saw was in the 70s, there was an oil embargo, and it actually put my father out of business. He pivoted and went to work for a factory and then a mining operation. I did some really entrepreneurial things. The biggest one, I'm from the Midwest, so we actually trapped. This was before PETA.
Okay. Okay.
Hey, you remember all the basketball players in the 70s wearing those fur coats.
Yes.
Yeah. And so we would trap furs, and as a freshman in high school, I would get up early and 5 o'clock in the morning, go run trap lines, and we would sell them. And heck, in the 70s, for a raccoon, I'd get $75 for a raccoon. I mean,
wow.
It was a great entrepreneurial way to launch my entrepreneurial career. And then I became an educator. I went to school, actually, a biology major, and I was going to be a dentist. And the reason I'm telling you this is because it's going to come full circle in just a second. But then I got into the football. I was playing some football. I decided I wanted to be a college football coach. And I did a graduate assistant year, and then I did some recruiting, and I hated recruiting. So I got out of that, and I got into education. And I actually taught biology for 17 years. But during my career, I was approached by a producer for Franklin Life. And unfortunately, they're one of the mutual companies that demutualized and was bought by AIG. We all know AIG.
Yeah.
And that has been a disaster for my policies that I bought at that time. But I got a taste of helping people with this concept. And to back up a little bit, when my wife and I bought our first house in 1986, this is before I knew about Nelson Nash, before I knew about the infinite banking concept. My dad, for my marriage present, he gave me my whole life insurance contract that he took out on me in 1963.
Okay.
And he says, you're probably going to want to buy a house. My father said, here's some money to buy the house. So I started doing the infinite banking concept in 1986 because I borrowed against the policy.
Right.
Put the down payment down on the house, and then I paid it back. Then I took out my Franklin Life one. My wife and I had an opportunity to move to California. Housing prices were really expensive there. So I took my Franklin Life one, borrowed against it for this increased down payment on the house, and then I paid it back. And then I went through this, and I did it part-time for a while, and then I moved back from California. I got back into the industry full-time in 2007, and then it was introduced to Nelson Nash in 2009. And I thought, I've been doing this my entire life. My father taught me this. I just didn't know what it was called. And so it really resonated with me. And Nelson and I we hit it off. Carlos Lauro, Bob Murphy, who are now running the place on the board. We hit it off. Mark Benson and I actually went to a Night of Clarity in Nashville. And we were like, we've been doing this our whole career. Now we have a framework that Nelson put together for us. And we thought we can help a lot of people do that. So that is kind of a real quick synopsis of how I got to where I was or where I am now. And then through Kim Butler and Prosperity Economics, we actually stepped down and we tried to do what we called our Freedom Advisor event. So we tried to get the industry to understand it's about service. It's about constantly helping people.
Which is where we met. That's so just exactly to be clear, when he was talking about the community, we met where were we the first time? We were in Scottsdale, I think. No. We were in
Park City, Iowa, maybe?
Park City, Utah. Utah. We met at the Prosperity Economic Summit for Advisors, which is a group of whole life friendly advisors, right? And that's where we first, and that was about 3 or 4 years ago. Yeah. And that's where we really, Kim and Todd and ourselves, our organization in St. Louis, we really figured out that we're trying to do the same thing. So we started supporting Kim and Todd, and they would come to St. Louis and do events, and we would go out there and help them with their events. And it's just been a really wonderful ride, because I'm finding, when I was doing this in the 80s, everybody was a rugged individualist. Everybody was fighting for clients. Yeah. And people they were just salesmen. And now we're educators. And we're actually trying to put content out like you're doing right now to try to tell people that this isn't something outside the box. This is just a bigger box. right,
for people to understand. It's not magic. I tell this to people all the time. They say, well, if this is so great, why haven't I heard it before? And I tell them it's because I haven't talked to everybody yet. This is not something magic. This has been around for 250 years. You just have to understand how it works. Nelson Nash put a framework to it so that we can now have a track to run on and a certified practitioners program to make sure people are not just commoditizing this. And Curtis, I know you see that all the time. People are just,
I mean, I tell people, look, this is not a gimmick to sell insurance. I mean, it's work actually, because you gotta, it's really more about utilization, and it's a system of, as what Carlos and Bob says, of cash flow management, right? And helping people. You got to help people, how do you pay back your loans? What is economic value added and paying back, being a good, being an honest banker, as Nelson says. That's work, right? And so I tell advisors to come, they want to hear about it. I say, listen, if you're not willing to work, this is not a gimmick to sell insurance, because there's a lot of service involved in helping people and education. And to me, that's a good thing, because we want to empower people in the conversation about money. Because I think they're getting so much bad advice, what Kim calls typical advice, which in the long run, it doesn't work, And so Bruce has been doing this all his life. I always tell people, look, why haven't I heard about this? I said, this is not you. It's just new to you. And
that's a great way of saying it too.
Yeah, it's just new to you. I mean, banks do this. Banks, this is where they store their tier 1 capital. I mean, other people have been doing it. They just neglect to tell you about it.
Right. And
thank God I got here, right?
Yeah, it's a difference between the utilization of your money and appreciation of your money. And I tell people all the time, if you want to go down the typical road, where you're trying to accumulate this great big mass of money and then live off of, first of all, it must not be working, because we wouldn't have a retirement crisis here in the United States if it was working.
Come on. Yep.
The second thing to consider is, everybody thinks, well, if I can get to $1 million, I don't know why everybody uses that number all the time. And just for your listeners, I'm also a financial advisor. So I'm not just a producer. So we do talk about these concepts with clients. If you get to $1 million, typically, if you do some research, the typical financial industry would say you should only take about 4% off of that every year, or risk your principal. Well, that's $40,000. Now that's $40,000 that's taxable.
Right.
Okay, so now you take the taxes out of it, and you may have maybe 30, let's say you have 35 to 36,000, because you are going to be in a lower tax bracket. And I tell people all the time, well, why do you want to be in a lower tax bracket? People say that to me all the time. Well, when I retire, I won't need as much money because I'll be in a lower tax bracket. Well, but that also means you have less money coming in.
Right. You're poor.
Yeah.
You're planning on being poor, and you paying somebody for that advice,
So let's just think about this. So you've worked to get $1 million together, and now you have $3,000 or $36,000 for the year. $33,000 a month for accumulating $1 million, if you can accumulate $1 million. But many people have shown over and over and over that that's not possible. And then people say, well, wait a minute, Curtis or Bruce, I can actually, as I get older, I can pare down that 1 million and then not leave anything. And I say, well, yeah, but I thought leaving a legacy was important to you. And it is important to a lot of people.
Right.
So people say, well, then I want to live on less money so I don't run out. And I also want to leave it to my kids or a charity or somebody else. So they scrimp and they don't live this great life. And so our message to them is, why don't you actually set up a place where you can control your money and then purchase cash flowing assets, whether they be real estate, whether they be other businesses, whether they be private notes, whatever cash flowing asset that you can figure out in your life. And then you don't have to accumulate this big mass of money and then only scrimp and save off of that. And oh, by the way, when you pass, or as Nelson used to say, graduate from this earth, right, that bucket gets filled back up for your legacy. So you give yourself permission to actually spend
your money. Mm-hmm. So it's filled back up with tax-free dollars.
And it's tax-free dollars, yes.
Tax-free dollars, yeah.
Yeah, so that's the message that we try to get out to people, and it's very difficult, Curtis, because people believe what's the noise that's out there, and I don't blame them. I mean, there's all kinds of noise out there, but we always say, who's giving you this information? Well, think about it. It's people who's benefiting, you or them. Typical financial institutions try to get you to send them as much money as possible in a systematic way. In other words, take it out of your paycheck or take it out of your bank account. Then they want to keep it for as long as possible. Then they want to trickle it back to you as slowly as possible. Right. Now, I'm not making this up. This is exactly what everybody in a typical financial situation is doing it. Oh, and by the way, if it's in a qualified plan, which most of it is, like a 401k and an IRA, you can't access it for a great opportunity without ramifications, whether it be additional penalties, whether it be, oh, by the way, you're going to have to pay it back in a certain time. If not, then we're going to have to make you pay taxes. There's all kinds of things, and people are hurting. I just saw this the other day, Curtis, and I have it somewhere. I maybe could send it to you. Since 2015. Now, this is a great time in our supposed economy, right? 2015. Right. People have accessed $69 billion a year on average from their qualified accounts prematurely.
Wow.
Now, think about that. That means they're giving up $6.9 billion of additional taxes that they wouldn't have to give up if they did it somewhere else. Because people always say, well, I'm saving taxes if I do tax-deferred money. And what do you and I always say? You're not saving taxes. You're delaying the taxes.
You're delaying, and the better word is postponing.
Postponing, yeah. Postponing is a better way. You're postponing taxes. And what you're doing, you probably end up doing, like these Americans, these $69 billion that have been taken out, you're paying additional $6.9 billion in taxes. So you're actually paying more in taxes. We can go in this tax rant for a long time, Curtis, but I don't know exactly
that. And taxes. I think one of the things is just to talk about that. You have to look at if taxes is one of what I call the top 5 wealth transfers. How you pay mortgage taxes, how you fund retirement plans, how you pay for educational expenses, and how you pay for major capital purchases. So there's more money lost if you really understand what's going on with those 5 things than you'll ever make trying to pick winning investments. And, so one of the things that we tell people, if you want to create maximum wealth, it's not chasing investment returns. You want to start with creating maximum efficiency first, right? You want to become efficient because you can control that. You can't control. If you have money in equities right now, what is going on with that? And you don't have any control about a virus, but all of a sudden your portfolio may be down. If you're into that, and I'm not giving any investment advice. So I'm just saying.
I can give investment advice, but what's interesting is I've already had several clients that said, hey, I'd like to access some of my borrow against my cash value of my policy because I have an investment opportunity right now because of all the turmoil. They could have securities. You could have securities that have appreciated value now that have gone down, and now sell them at a loss.
Right.
But people are always like, oh, I don't want to sell it now because I want to wait till it comes back. That's the way they miss out on the investment. But here you can access capital for about 5% of most insurance companies. You can go and deploy it into a cash flowing asset. I just got off the phone with one client, and they're doing a mortgage note business and they're getting a return of 12%. Well, they're accessing capital at 5%, mortgage notes at 12%. So they're making a net return of 7%. So that's the velocity of money we talk about all the time is how are you utilizing your money? Don't just let it sit there and what we call on our end, buy, hold, and hope.
Right.
We don't want to buy, hold, and hope. We want to utilize. We want to hold and then utilize.
Hold and utilize. I like that. I'm going to steal that. Hope is not a good strategy. Last time I checked. So what are you telling I guess you just said it, but if there's another way to do it. So you probably not getting those calls. Like if our people, if they restructured things right, we're not, the calls I've been getting are, hey, how's that thing? You know, I says, you know, the policy thing, is everything all right? I said, yeah. You want some money? No, but how would I get it? I says, well, you know, the company I use, if it's under 15,000, you just call them and they'll wire it to you. And if it's more than that, we just fill a form out and tell them where you want them to send it. Oh, okay. Boom. These are like, you know, the messages I've been getting, you know, so it's like, oh boy, I'm glad, you know, that, you know, I had some people listen to me. Hopefully with the show between you and I, we can get more people to get this message that there's a way to, you know, sleep at night. There's a way to have your cake and eat it too. You know, Caleb, and I know Todd calls it the and asset. You know, it's not either or, it's and.
Right.
And so talk about, so what do you, so to my point before I go off on my rant, what are some things, if we haven't talked about, that you would tell, or you're talking to your business owners, and I got a follow-up question after that, you know, if anything, that right now take advantage of these opportunities, you know, keep a calm head, and what can you do?
Yeah, before we talk about opportunities, let's talk about having money in this position is allowing a lot of my business owners to actually meet payroll in these difficult times. Mm-hmm. So we had one business owner that has been putting a lot of money in this, and they have about $500,000 of payroll per year. He doesn't know how long it's going to be before this is kind of normalized. And he coincidentally has $500,000 of cash value in his policy. He is not panicking right now, because he knows he can keep his people on, and they can actually innovate, and they can change the way they're doing business so that they can come out the other side and be more efficient. Right. If he didn't have that, he would have to lay off people. Well, that's not great for people on a personal level. Right. But it's also not great for the business owner, because now he's going to have to go and now teach new people when things do turn around. Right. They don't use this time to innovate, and so they don't come out of the other side even more efficient. So the first part of it, having money in these positions, businesses can actually weather the storm, and not just weather it and come out the other side, but actually come out the other side in a more efficient manner. I'm gonna bring this up with another. This isn't anybody that has a whole life with us, but to give you an example, we provide alternative investments for our clients also. So we have the foundation of the whole life utilization, but then we also have people that still come to us and say, hey, we want to do other investments. So we still have people that do securities, but then we do things that are alternative investments. So real estate investment trusts. We do tax minimization strategies, such as easements, oil and gas programs, so on and so forth. One of the greatest examples of this innovation coming out the other end there's a company, I won't mention their name, but there's a company in Texas in the Permian Basin. And when gas prices actually went down in 2014 after the Great Recession, instead of they had enough capital available, and this is all we're talking about, right, Curtis? Right. Having capital available. They had enough capital available. Instead of laying all their people off, they kept all their people on, and they practiced taking the rigs down, moving them 100 yards and putting them back up, and taking them down, moving them 100 yards, and then putting them back up. Why did they do that? They said, well, when we come out, when gas prices, oil prices start to go back up, we are going to be able to drill rigs faster than any other company. Then they asked their engineers during this time period, how can we actually make these rigs to where they're actually easier to take up and down? The engineer said, we'll do one. They came up with one step even better. They said, we don't even have to take them all the way down. They actually made mechanical feet that actually could walk these big rigs across the landscape. So they only had to take them down about 20%, and then they just walked them across. So these are the kind of things I want to bring in hope for your listeners too, that we have gone through pandemics in our entire civilization of man. Man's been around for about 60 million years. And yes, there's been good and bad things, but if you have the individuals, and this is what we were talking about earlier, you have individuals that can actually work together and figure things out without a lot of red tape. then we can actually come out the other side in a lot better situation, not only as a society, but for each individual businesses.
Yep. I love that. I mean, I was telling my wife, I said, I'm excited because I think you got to, like I wrote down in my journal, what have I learned from this? Like things I've learned, better prep, But I also see opportunities for businesses to, work on their marketing, work on efficiencies and, stop waiting around for some stimulus program to solve your problem, or somebody else. So the theme of my show is kind of like, stop waiting for other people to solve your problem for you. You are the captain of your ship. Absolutely. And so that's both our, personal responsibility, libertarian mindset, of personal property, all that kind of stuff. So that You'll see if you listen to both our shows, that undercurrent going on. But that's cool.
Here's the thing. I was really proud of one of my nephews the other day. He says, I don't want that $1,200, that he was going to get. He goes, I'm not cashing a check. And I'm like, okay, now wait a minute. First of all, it's not government money. It's your money.
Yes.
Okay. So it's great that you have these character building moments, but let's don't be silly about this.
Right.
Okay. All you're doing is cashing your future money. That's all. Well, heck, you're probably cashing your future grandchildren's money. And he's only 24. He's only 25 years old. So, but he's probably cashing his future grandkids' money. So yes, businesses, and I hope this is all right to say on your show, Curtis, what we're going to probably go through is a financial enema. So what happens is that the businesses that aren't very efficient, and this is where the businesses that are and have capital are going to gobble up these businesses that are well run when things are good.
Right.
And they didn't take the personal responsibility to hang on to capital for when bad times. So they're going to grab really good businesses that could stay in business in good times, or they just can't stay in business in bad times. So they're going to gobble those up. And there's going to be economies of scale that are going to be good for that new business, or not the new business, but for the established business that bought the business up. And frankly, the business owner is going to be better off because he didn't prepare, but he's going to get something for his business. He's going to get, he's going to get a discounted rate, but he's going to get something for his business instead of just going out of business.
Right.
But all these people that have these access to capital, like many of our clients do, are going to be able to get things on pennies on the dollar. And so yes, you have the peace of mind of having capital so that you can keep your people on and become more efficient. You don't have to wait for this, whatever they're giving out, like a $10,000, automatic business loan right away if you get it. I think you and I they say they're going to get it to you in 3 days. I think you and I don't believe that's going to happen efficiency-wise.
I really don't.
But they don't need that $10,000 loan because they have the money that we can get to them in a very quick time.
In 3 to 5 days. We can actually do that, right?
Yeah. And we can actually do it because I've done it. I've proven that over and over.
Mm-hmm.
I don't know if you've ever done this, Curtis. What we like to do with some of our people that are really, we know they're going to utilize their assets is we have them, even if they don't need the money, we actually have them right after they set up their policy, we have them take a loan and so they can see how fast it's going to get into their bank account. And then we just have them immediately pay it back.
But that's a good idea. Because I told people, look, you really don't believe me till you do a loan,
So just have them take $1,000 loan, and then they can just pay it right back until they need to utilize it in the future. The other thing I think you have to get over people, and they have to have kind of the same attitude as you and I have, is we're all going to figure this out. We want everybody to be honest bankers, and that is about paying the loan back. But you also have to be you have to weigh the opportunity to what you're actually going to be able to cash flow right away. So like if you do buy a business and you've done a good analysis of it, the P&L, the pro formas, you've had your CPA look at the tax ramifications, so on and so forth, and you say, well, I may not cash flow for 3 years. Well, you may not be able to pay that loan back, right away.
Right.
And people are saying, well, wait a minute, then you're actually violating what Nelson says. And And actually, I've had a lot of private conversations with Nelson. God rest his soul now. He's been dead for about a year. But one of the last things that Nelson said to his son-in-law, David Stearns, was when he was on his deathbed is, hey, David, how much do you have loans outstanding in all your policies? And David has like 30 different policies on all his kids and grandkids and so on and so forth. And David was a little sheepish to tell Nelson because Nelson always talked about being an honest banker.
Right.
And David said this publicly, so I'm not saying anything that's confidential. He said this in a public forum. He said, well, Nelson, I actually have $500,000 of loans out right now. And he goes, I thought I was going to get the wrath of God down on me because I had so many loans out. And Nelson turned to him and said, good. He goes, because in my death, I'm going to be passing a lot of tax-free money down to you. You need a place to store that money.
Right.
So being an honest banker doesn't mean that you just take a loan and then immediately pay it back. You have to actually analyze what you're using that money for. So like right now, people could be taking a loan to purchase some businesses that they believe after they make them more efficient are going to cash flow, but it might be a little bit of time. I want to tell your listeners, don't hesitate and be so strict with this honest banker that you say, well, it's not cash flowing now, I'm not going to do it. If the numbers look good a couple years down the road, you can just accelerate the payments.
Oh, I'm so glad you said that, because a lot of times I never get that granular on the show of how to manage the money. But I always tell people you have access to capital, unstructured payments. So the company just cares about the premium and the interest, really, right? And so if Nelson says, so what do you do with windfalls? Pay the loans off. Right. So when you get a windfall, or if let's say that business starts cash flowing in 6 months, 18 months from now, let me ask you this, because, creating a way, because since we're on this, let me just go here, because I've got my clients that listen to this. So in managing the loans, like you create a separate account.
Yes.
Talk about that concept for a minute, creating that's really the bank.
So what we like to do is we like to have a separate bank account that people use as a cash flow system. And people all the time say, well, I need $1,000. I need $2,000. Should I really bother you for this? And we're like, okay, why don't we do this? Think about this. In your business account, you have a ceiling and a floor every month. You have revenue comes in, and then you pay out all your expenses, and then it gets down to a floor. And then you start the process over. You got accounts receivable and accounts payable. And we always say to them, is there a number down at the bottom that you start to feel nervous about?
Okay.
Like, yeah, I don't like that to go any less than $10,000. And we say, okay, well, you have $150,000 in your cash value, but if it gets below that 10,000, you don't want to call us because you're nervous. And you have it. Why don't we set up a separate bank account over here, and we just have you go ahead and take $10,000 out of there and have it sit there. And that way, if it actually makes you nervous, transfer $1,000 to make it back up to $10,000 in your business account. Right. And then you won't be nervous. And then every time you have excess, whatever the ceiling is, every time it goes over the ceiling, well, then make a payment back to your cash value life insurance policy and pay the loan back.
Right.
And so think of your money management as a floor and a ceiling. So you don't want to go below the floor. And when you go over the ceiling, don't just leave it set there. Actually pay your bank back. Right. And then you can call us up and say, hey, my floor is getting low. Okay, we're not going to build up the floor every time, but we're going to have a separate bank account over here that is actually your cash management account so that you can keep your floor and ceiling where it makes you feel comfortable, and you can go take money out of that bank account, which is your cash management account.
Oh, thank you for that detail. That strategy applied to, I know it's similar, but I want to hear you say it. let's say a real estate investor, and then just for a household, a family,
Sure,
managing their cash flow.
Yes, you can also do that for your personal economy. We call it business economies and personal economies.
Mm-hmm.
So you could do it to manage your own personal economy also. I do it with my own personal economy when I'm paying both my mortgages and my basic bills, and then I do it on my business economy because I store all my estimated tax payments.
Yes.
And big ticket items for like my E&O insurance, which I pay like $5,000 a year for my securities and my insurance, and I store all that there. And because I want to put it into my policy first, so I get those uninterrupted compounded interest and dividends. And then when it's time to pay those, then of course I use the cash value that I put into my cash management account, and then I pay it out of the cash management.
So because I showed a client this, I said, listen, he wrote like a check for the IRS for like $30,000. I was like, dude, you're killing me. I says, don't do that. I said, you got this money over here that we've set up. So this time he says, all right, how do I do this, Curtis? So we took a loan against his plan. And then I said, you got it in there. Let's borrow against it. Let's put it in your cash management account. And then you write the check to the IRS from that account. And then you use your new cash flow to pay that down.
Right. Pay it down or pay an additional premium.
Or pay additional premium. Yeah.
Pay more PUAs.
Right. Or both, and so the thing is, Robert Kiyosaki says you want to get money into your asset column and never let it leave. And this is kind of using this, you can kind of accomplish that. You can take you can leverage your cash value and buy a turnkey property or real estate. And all of a sudden, I had a client, we did it. And we took a policy loan for the down payment. She financed it. The property itself is doing an 18% cash on cash return. And then we took the cash flow and we're paying down, I said, look, when your rent's coming, they go into somebody's bank.
Right.
I'm doing air quotes. Why not yours? Right. And just pay that back. But it's really better than that because it's 100% finance because she's not using her money. She's using the insurance company's money.
Correct.
That's really infinite return when you really think about it. So that is, okay, so we answered that question. That's awesome.
One of the things I think you wanted to talk about is, these crazy times that we're going through right now and guaranteed money. And you and I were both athletes. And of course I coached for a while and so on and so forth. And we have a division that actually works with professional athletes. And one of the things that we talk to them about, and I think this will resonate with some of your listeners, because a lot of people do follow sports, is what do you hear about agents when a person is holding out? They're always saying, we want to get this guaranteed money.
Right.
And they have millions of dollars. Okay.
Right.
And they're trying to get guaranteed money. So, but the bad part about the athletes though, is then they have all these people that see all this millions of dollars. And when I say these people, I'm talking about investment people.
Right.
And so then they say, oh, you got all this money. Now let's go put it into this wild investment scheme.
Right.
And our question to them is, why does your agent work really hard to get you guaranteed money and then you place it in non-guaranteed places? I mean, it's just a simple question.
How about that? Yeah.
You can do it for your own personal economy. Somebody makes, a middle class that makes $100,000 between two working adults. Why are you working so hard for your money and then you're putting it in non-guaranteed places? Just like these athletes are always working for guaranteed money, they should be putting it into guaranteed positions. So that's just a simple question.
It's funny because with them, you don't even have to invest. You just need to not lose it because you're making so much money.
No. And I would argue the same. I would argue the same way now. People are saying, well, look at how the stock market did from 2009 until, February of 2020.
Right.
It did really, really well. Well, now it's back below 2017. So really you got negative returns for the last 3 years. So what we're constantly fed is this like aura of what is possible out in the future. But what we really don't focus on is what we know is going to happen in the future. And that's the guarantee side of it. Unfortunately, Curtis, I think a lot of people, I noticed this in our business after the Great Recession, 2009, a lot of people fled to the infinite banking concept, the guarantees that whole life.
Right.
And frankly, the insurance industry can give you with annuities and other products. Then they started seeing the stock market taking off and probably heard from their friends, oh, I'm making this. Why are you just doing this very conservative thing? And now, unfortunately, they're seeing why they're doing this. They should have been doing a very conservative thing. And
or they are doing it. And so what happens is a lot of the companies, because are doing kind of like a hybrid of that, where they're saying, well, you can have the best of the both worlds. You can get the ups of the market without the downside risk. Let's spend a few minutes on that.
Yeah, that's great. I tell all people, if you want to invest. Okay.
Right.
If you want to have guarantees. Okay. But don't actually merge the two. And that's what we were talking about, is that actually an index universal life, or even worse, a variable universal life.
Right. No floor.
Right. Everybody thinks this. Yeah. Everybody thinks this index universal life policy is the way to go because they can illustrate it. They actually illustrate it with uninterrupted compounding.
Right.
And most of them are right about 5.65%. They're illustrating it. But that means for everybody out there that's listening, that means they're going to get 5.65% every year uninterrupted for that time period. Well, we're already doing this product because we're saying you can't lose money. So some years you're going to get zero. So we already know that the premise that it's going to do that is wrong, because that's what they're selling you, is that when the stock market's going to go down, you're going to get zero. So we already know that premise doesn't work. Now, the other thing is they say you can't lose money. Well, you can't lose money because of the investment, but you can lose money because of the fees that are involved. Now, when you have several years where you have money that's being lost in the stock market, or an index, I should say, in the index, then what happens is the options that they're using to protect these actually become more expensive. And that is why if you ever look at an index universal life contract, it can be a half an inch thick.
Right.
No, it might be 85 pages. Where you look at a whole life insurance contract, and it might be 14 pages.
Right.
And that's because it's very easy to have a legal description of guarantees.
Right.
It's not easy to describe, oh, well, if this happens, we're allowed to do this. And if this happens, we're allowed to do that. Oh, and by the way, yes, we can actually jack up these fees if we want to, based upon these situations. And the other thing that happens is it's human nature. Nelson taught us about human nature. And I get in these discussions all the time with IUL people that they say, well, if you max fund an IUL policy, you're never going to have a problem. Well, that's true if you max fund it.
Right.
Okay. But life gets in the way. And what you're going to end up happening is, because I've seen this, I've actually sold index universal life policies over my career. And some I'm not embarrassed to say I sold them, because there are other reasons to do it. Because you can actually get more death benefit in an index universal life early on than you can with a whole life for the same amount of premium. But they have to understand that premium has to continue because of the increase of cost of insurance that isn't figured.
Right.
And also with the increased fees that are more than likely going to come along in the situation. So people say that, oh yeah, I'll just max fund it. My guy knows he's got to max fund it for 30 years. Well, Curtis, I've been in this business for more than 30 years, and people don't do what they say they're going to do.
Right. They forgot what you said 3 months after you delivered the policy.
That's exactly right. As some of my clients say, and I'm embarrassed to say this, but they say, we understand it when you're saying it, but then on the ride home, we're like, I don't remember what he said anymore.
Right.
And that's why they have my personal cell phone number, and I tell them, you call me when you get home, because I want you to understand it. So yes, it's not that it's a bad product, it's a bad strategy. And I tell people that all the time. It definitely is not good for infinite banking, because if you have a loan against it and you have a situation where you have human nature not maxing the premium payments that you can pay, and you have increased costs of insurance, and you have increased fees, these things are going to eat themselves up, as we've seen warnings over and over again on these universal life policies.
That's, yeah, and it's funny because on the top, so if you're like have this and you just like only scenario, I don't really see a scenario, but I'll give you, so if all of the whole industry is set up to prop up the stock market. So if they're going to prop it up, maybe if once you got enough like guaranteed money and you just want to have the potential to capture some of that inflation, maybe. Okay. And I still probably wouldn't do it, but I won't.
Here's what I would say then.
Yeah.
Once again, don't mix them. Just go out and get you an indexed annuity.
Right.
And that way you don't have to worry about the increased cost of insurance. Okay. Now they can change the fees, but at least you don't have the increased cost of insurance going along. But if you want to try to capture some appreciation, and that's where I get it. Do your insurance one place, your guaranteed money one place. And do your appreciation place somewhere else. And if you still want to have a floor, well, then you can do an index annuity play for appreciation.
Right.
E3 just had a due diligence meeting this morning, and we are researching all the volatility indexes out there, because we actually think with all this government money, it's going to actually mess with the robo-advisors, because that's what causes a lot of these problems right now.
Yeah.
And robo-advisors, the computer programs, they try to work in the volatility, but they can't work in the human emotions on these whole things in their volatility. So as they get better and better at doing that, these volatility indexes, we believe, will be better for the indexed annuities in going forward than it actually will be for the S&P 500. Because they can't we just don't see a situation where they can continue to throw. I mean, Curtis, they say it's 2.2 billion, but they keep adding to it. It might be trillion.
Trillion. Mm-hmm.
I'm not used to saying that word.
I know.
When you and I were growing up in the 70s, we didn't even know what $100,000 was.
Right.
I tell
that was a lot of money.
I tell people all the time, that's what inflation is.
Right.
If people don't know what a trillion is, we didn't know what 100,000 was back then.
You could buy a new car for like 10 grand, 15 grand, so like a Cadillac. So.
I use a Coca-Cola, I can remember putting 15 cents to buy a Coca-Cola, and now it's, even though it has kind of some of the least amount of inflation, because all they did was just keep making the bottles smaller and smaller.
Right. Oh, you know what? So here's one more thing I want to, because here's what the other thing that worries me about that the strategy we're just talking about was, then people will say, well, it's a tax strategy because you can now pull your money. You can tax-free retirement is the catchphrase with that.
Right, because they build up a lot more appreciation than they think they're going to.
Right, and then they are living off of the loans.
Right.
But see, to me, that's risky because you're putting a lot of stress on the contract, because so when Bruce says the fees are going up, that means that, and correct me if I'm wrong, here's how I say it. So look, it's term insurance and a side fund, basically, the chassis, right? And so the cost or the mortality charge, the cost of insurance increases every year. So if you fund it, you won't really see it, but if you're now putting money in and you're taking out via loans, you're putting a lot of stress on that contract. And, and they say, well, this is, and the other thing that kills me, they'll say, well, look, this is what it's done. We've been tracking the S&P 500, but in the same breath, you say, well, past performance doesn't guarantee.
Right. That's why it's 85 pages.
Right. Future performance. I mean, what does that mean? And we've never been in this before. So, yeah. So we're
here's the difference. And you mentioned Todd Langford. Todd's really good at explaining this. And it's 1 year renewable, and 1 year renewable means every year the cost of insurance gets a little bit higher. And then I have these detractors that challenge me on this all the time. They say, well, whole life is 1 year renewable. They just take the average of the 1 year renewable and spread it out the whole life. I said, yes, but they can predict, the actuaries can predict, they know what the cost of insurance is going to be.
Right.
Okay. As it goes up, yes, they know every year it's going to go up, but they don't know how much is going to be in their side fund to actually pay for that. And the reason that Todd enlightened me on this is because whole life endows. So the actuaries can actually know the year they're pointing to it. Right. Universal life doesn't endow because they don't know how long it's going to keep going. So they can't have a target that they're shooting at when they're doing that.
So tell them what endow means.
Well, endow means the actuaries figure out that if you have so much costs of the insurance part of the policy and the guarantees plus the dividends, that the actuaries are going to predict at age, most of the time the contracts go to age 121. Most of them used to go to 100, but now they go to 121, that the cash value will equal the death benefit at age 121. And that way they can have an accurate prediction of their liabilities, right? The tax, the death benefit, and they have a really good, accurate understanding of the guaranteed and the dividends because they've been doing this for 250 years and they understand more. They only have to deal with mortality and very conservative things like treasury notes and bonds, which are very conservative. So it's not like, oh, we got to figure out how the index is going to work here.
Right. I tell people, look, I'd rather bet on actuarial science than Wall Street any day of the week.
Yeah.
Certainty. And you take your risk in your business, in your real estate, in things you understand, and you don't need the contract to be risky. You just need a stable place to store cash. So when you need it, it's there.
Yeah.
It's really that simple.
It is that simple. Why do you work really hard to get a pay raise and then put it in non-guaranteed places? I mean, I think it's really.
I'm stealing that. I love that.
I mean, athletes do it, but people do it too. You want to go to your boss and get a $10,000 pay raise, and then you go put it in a non-guaranteed place. I just don't get it.
Yeah, Nelson says you have to put on noise. All the noise. The noise is all based on all this stuff is based on what I call the accumulation theory, right? And but clash velocity is the method. That's like fact. That's when you study institutions and wealthy people, they don't buy and hold, dollar cost average, get out of debt, and buy term investor difference. They don't do any of that because they literally do the complete opposite. And so those strategies work in personal finance. And that's what Bruce and I are teaching, just, is teaching you the game. There's a game being played and you're on the wrong side of it. We just want to help you get on the right side of it. Bruce, any to close, I know you got to wrap up. This has been so much fun. We'll do this again one day. Any good things you're reading, any words of wisdom or closing thoughts for my audience?
Well, I think here's what you have to dig deep down into what you really believe. And like you said, get away from the appreciation model. I always used to, when I was talking to my players, and I'm sorry I keep coming back to my other career, but I think it's really important. You're not one way in one aspect of your life and then another way in another aspect.
Yes.
So I used to say to my players, if you take shortcuts on the field or on the court, you're going to take shortcuts in the classroom. You're going to take shortcuts with your family. So if you truly believe that the appreciation concept makes you nervous, don't follow the crowd.
Right.
Follow you because you want to be the same way in every aspect of your life. If you believe this and you're conservative in this aspect, then you should be conservative in your business dealings, and you should be conservative where you're putting your money. And then the final thing is that people say, "Well, I don't want to be a business owner, or I don't want to be a real estate owner." Well, you can actually invest in businesses and real estate without actually owning the business and the real estate. And we can get into that in another podcast. They're called alternative investments.
Yes.
And they're becoming, thank goodness, Curtis, I don't say much about government very much, good things, but it used to be that the SEC, the Securities Exchange Commission, used to call these Regulation D, and you had to have $1 million of liquid assets are $200,000 as a single person making it in a year, or $300,000 as a couple. Now, as of the Tax and Job Act of 2017 with President Trump, his administration brought that down now to where it's like for certain investments, it's only $75,000 of income.
Wow.
And that allows you to actually invest directly into these businesses, not into a stock, but directly into these businesses or directly into these real estate projects. So you don't have to directly own them, but you can invest directly into them and get the returns just like you are an owner. You don't have to.
Wow.
Say,
yes. That's another podcast. Matter of fact, that's an off-air conversation you're going to tell me about.
Yeah, no problem.
And wow. So Bruce, tell me the name of your podcast that they need to listen to that.
Yeah. So I'm with an independent financial firm in St. Louis called E3 Consultants Group. And we have a wealth division. We have a consulting division. We have a tax division. We have a insurance division. When I say insurance division, it's life, health, property and casualty, so on and so forth. And then outside of that, one of the other businesses that I've built is an internet marketing business with Rachel and Lucas Marshall. I think, Curtis, you may have met them too at Prosperity Economics. And it's called The Money Advantage. And basically the concept is how to build a business and life that you love. And we dive into, matter of fact, just this coming Monday, Curtis, we're launching a 20-hour, I think it's 20-hour and 20-minute course on infinite banking.
Wow.
I mean, it's a video, 20 hours of videos on how infinite banking works, how to look at illustrations, what you should consider as far as which companies you should use, how you should fund these, how you should look at cash flow, all these different things. How do you take a loan? How do you pay the loans back? All these different things that we're talking about on the podcast. So yes, I work, my securities is with E3 Wealth. And then I have the Money Advantage podcast and marketing with Lucas and Rachel Marshall.
Wow. See, and the name of the podcast is? The Money Advantage. You told me that. The Money Advantage Show.
Yeah.
I mentioned that.
On iTunes, wherever you get your...
So we're going to put a link to that. And so if you've got any questions, reach out to them. And I appreciate you being so gracious of sharing with our listeners because, you know, this is an expert. So I wanted to hear that. And we went into great detail. So I'm so excited about that. So for my clients that are listening to this, you know, every week, I want this to be like an annual review, right? so that you can get good information out there. So, hey, so I'm going to have all of Bruce's stuff in the show notes. And so you can, you know, listen to him, look for the course. Bruce, thanks again.
Oh, of course. It's our pleasure. It's always great just to see you and talk to you.
Yes. So same here. And guys, thanks for listening to another episode of the Practical Wealth Show. And we will talk to you next week.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.